We're jumping straight into RedCat Holdings today. Everyone is watching the price action, but the real story is defense tailwinds and the execution inflection.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the nuts and bolts of how a company grows that fast, do us a favor, subscribe and hit the like button. We're here to simplify the noise, and you don't want to miss the next breakdown. All right, let's start with the elephant in the room, or maybe the rocket ship on the screen. If you pull up a chart of RedCat right now, it doesn't look like a normal stock chart.
Not at all.
It looks like a vertical line. We're hitting all-time highs of $16.71. It is trading at a massive premium. I mean, we're talking 71% above its 200-day moving average.
It's absolutely vertical. And I'll be honest, usually when I see a chart like that, just straight up without pausing, my first instinct is bubble.
Right. Retail pump.
Exactly. That retail traders got excited on a forum somewhere and, pumped it to the moon. But this is where you have to be careful. If you just look at the line, you miss the actual fundamental shift that's happening underneath.
Okay.
This isn't just momentum. We are seeing explosive revenue acceleration. And I'm not throwing that word around lightly. We are talking about 646% year-over-year quarterly growth.
That number. I mean, 646%.
Yeah.
It almost sounds fake. In most industries, if you get 10% growth, you're popping champagne.
Yeah.
This is just an explosion.
It is.
But we need to contextualize that, right? A percentage that high usually means the starting number was tiny. Like, if I sell one lemonade and then I sell 6, that's huge growth, but I'm still just selling lemonade.
That's a fair check, a necessary one. And yes, this is comparing against a period where RedCat was a much, much smaller entity. This is Q3 2025.
Right.
But here's why it's not just a statistical quirk, it's the trajectory.
Right.
The market is excited, foaming at the mouth, really. Not just about what they did, but what they say they're going to do. You have to look at the preliminary revenue guidance for Q4.
This is the forward-looking stuff. This is them putting their neck on the line.
Precisely. So Wall Street, the analyst consensus, they were modeling for, about $20.9 million in revenue? That was the bar.
30.9.
But RedCat came out and just smashed that. They said, no, we aren't doing 20. We're looking at 24 to 26.5 million.
That is a massive beat.
It's a 15 to 27% beat. And what that signals to institutional investors, it tells you that demand is outstripping their own models. It signals they're transitioning.
From what to what?
From that scrappy prototype phase, R&D, burning cash, making promises into mass production. They're not just designing drones in a lab, they're shipping them in boxes. That is an execution inflection point.
And clearly shipping them fast. But I want to dig into why. Because you can build the best drone in the world, but if nobody can buy it or there's a cheaper option from overseas, it doesn't matter. This is where it becomes a geopolitical story.
This is the single biggest driver. Without the geopolitics, RedCat is just another hardware company. With it, they're a strategic asset.
Right. We keep hearing about the FCC and the NDAA, the National Defense Authorization Act, specifically Section 1709. Now, that sounds like the most boring thing on earth.
That sounds like a tax code.
Yeah, but for RedCat, is it fair to say this is basically a golden ticket?
It's the ultimate barrier to entry for their biggest competition. Think of it this way. For a decade, the drone market was owned by DJI, the Chinese giant.
Oh yeah, everyone had a DJI.
Cheap, effective everywhere. Police departments, surveyors, even the government bought them. But Section 1709, it enforces a ban on those Chinese-made drones for any government use.
So it's not a tariff. It's not pay a little extra. It's a do not buy list.
Correct. With data security concerns becoming paramount, the U.S. government has just cleared the playing field. They said, we can't have our defense infrastructure relying on hardware that sends data back to a strategic adversary.
It's like the referee just gave a red card to the entire opposing team.
In a way, yeah. And that creates a vacuum, a huge hole in the U.S. defense market. We're talking over $10 billion annually. The government needs drones.
But they can't buy the ones they used to.
They legally cannot. They need NDAA-compliant, American-made drones to fill that specific gap.
And RedCat is just standing there with a glove ready to catch.
They are. And this creates a de facto monopoly for the compliant companies. Now, you might ask, why not the other big guys? Why not AeroVironment?
Yeah, they're the heavy hitters. They've been around forever. They make the Switchblade. Why don't they just crush RedCat?
They're great at what they do. But think of AeroVironment like an aircraft carrier. It's powerful, but it takes 5 miles to turn around. Big means slow.
And RedCat's a speedboat.
Exactly. They have agility. They found a specific, maybe a 2 to 3 year window where demand for these small tactical drones is skyrocketing and they can move faster than the giants. While the big guys are pivoting, Red Cat is already sprinting.
So you have the growth, the agility, and the government banning your competition. It's a compelling setup. But usually when a stock goes from $4 to 16 this fast, I just think retail hype?
Meme stock,
Okay.
rocket emojis.
Right. But that's not what's happening here anymore, is it?
No, and that's a crucial distinction. We're not just seeing retail traders. Look at the volume surges up to 18 million shares. That takes serious capital. But the real tell is the 13F filings.
Where the big funds show their hand.
Look who just filed a 7.3% stake.
BlackRock.
BlackRock, the biggest asset manager on the planet.
Okay, let's pause on that, because people hear BlackRock and think smart money. But what does it actually mean when they take a 7% position? They don't just throw darts at a board.
No, they have risk committees, due diligence teams, people whose entire job is to tear a company apart before they invest a cent. When BlackRock takes a stake that size, it signals mega cap confidence.
They believe the story.
They believe the production ramp is real, it validates the thesis, it gives the stock permission to be held in serious portfolios.
And speaking of that ramp, Red Cat is doubling their production space.
Which they have to do. If
Yeah.
you want to hit that $26 million target, you need the floor space. You can't build that many drones in a garage.
And it's not just air anymore. They're launching a maritime drone division, Blue Ops USV.
Which is a smart strategic move. USV is unmanned surface vehicle. If you look at modern conflict right now, maritime drones are just as critical as aerial ones.
So they're not just a drone company, they're an unmanned systems company.
You're playing the full board.
Yeah.
And they have the tech, the Black Widow platform. What impressed me wasn't just the specs, but the logistics. They're quoting 6 to 7 week lead times.
In the defense world, that's light speed.
It is rapid, and it shows they have control over their supply chain. They aren't waiting on parts from overseas. Speed is a feature in this market.
So that's the bull case. And honestly, it sounds fantastic.
Uh-huh.
Revenue up 600%, government bans your competition, BlackRock's in. Sounds like a slam dunk. Why isn't everyone putting their life savings in this?
Because there is always a but.
There's always a but, and we have to look at the flip side. Let's break down the bear case, because if you just look at the growth, you miss the bank account.
Right. Time to switch from the story to the spreadsheet. Revenue is vanity, profit is sanity. And right now, Red Cat is not profitable.
Not even close.
No. If you look at the trailing 12-month numbers, they have a net loss of over $90 million, $90.46 million. The EPS is negative $1.01.
Ouch. So for every share you own, the company lost $1 over the last year.
Essentially, yes. They're spending way more than they're making, and the gross margins have been negative too, around negative 38%. Now, those are improving as they scale up.
That's normal for manufacturing.
Right. But the cash burn is the scary part. In Q3 2025 alone, they burned $16 million.
$16 million in 3 months.
Yeah.
That is a serious burn rate.
It is. And here's the risk. If you're burning that much, you need a lot of cash in the bank. If they don't hit positive cash flow in 2, maybe 3 quarters, the math starts to get ugly.
What happens then?
They might have to do a dilutive capital raise.
Okay, break that down. Dilutive capital raise. What's that mean for the average person holding shares?
Think of the company as a pizza. You own a slice. When they do a dilutive raise, they're cutting the pizza into more slices to sell to new people. The pizza didn't get bigger, but your slice just got smaller.
Investors hate that.
It's the quickest way to kill a rally. So Red Cat is in a race against its own bank account. They need revenue to catch up to spending before the cash runs out.
So they're sprinting on a treadmill.
What?
But that's not the only dark cloud, is it? We have to talk about the lawsuit.
Yes, the shareholder lawsuit. This is the elephant in the room that the bulls try to ignore.
And what's the specific allegations? It's just a normal, the stock went down, so I'm suing thing.
It's more specific. The suit alleges Red Cat misrepresented its production capabilities for a key U.S. Army contract. Basically, that they promised they could build more units than they physically could.
That sounds bad.
It's a serious accusation. If the audited results in March show they can't deliver the volume they promised, the stock could face a massive correction. 30, maybe 50% downside, and they could lose those contracts.
That's a huge risk. But let me play devil's advocate. We just talked about BlackRock and Truist buying in now. Didn't they know about the lawsuit? It's public.
That's the strongest counterpoint. These institutions have armies of lawyers. They bought in after the news was public. That suggests they think the risk is priced in or just overblown.
And the guidance beat supports that.
Exactly. If they were lying about capacity, how did they just beat the revenue estimate by 20%? Execution cures all ills. But until that lawsuit is gone, it's a risk.
And then there's the valuation, nearly $2 billion.
For a company that lost $90 million last year.
That is a hefty price. You're paying for future growth, not current earnings. It's a classic pre-profitability profile. But if that growth slows even a little, the air comes out of that balloon fast.
Very fast.
So we've got a high-stakes setup. What does this mean for the next 30 days? What dates do people need to circle on their calendar?
It's going to be a very, very busy February. 4 critical triggers.
Okay, hit me.
February 13th, 2026, the big one. Q4 earnings and audited results.
The mode of truth.
This is where they validate that $24 million plus guidance. If they miss, look out below. If they hit it or beat it again, it validates the whole bull thesis.
Okay, Feb 13th is a report card. What's next?
February 27th, Innovation Day.
I love these. It's like a tech keynote for weapons.
It's marketing, sure, but it's effective. Live demos. This creates FOMO, fear of missing out. It shows the tangible product. It gets people excited, and it keeps the analysts happy.
And then March.
March 6th, options expiration. This is a bit technical, but there's very high open interest at the $18 strike price.
Open interest memes.
A lot of bets place that the stock will be at or above 18 by that date. It acts like a magnet, pulling the stock toward that $18 or $19 level.
And finally, the audited financials, sometime in March.
The final check against the lawsuit. If the auditors sign off, the lawsuit loses its teeth.
Now, price targets from analysts. What are those looking like?
They've been raising them. We're seeing a range generally between $19 and $22.
And we're sitting around $16.70.
Right. So there's implied upside. And technically, the stock has consolidated nicely around $16.38. Every time it dips, buyers step in. That's a sign of strength.
A coiled spring waiting for that next catalyst.
And that direction depends entirely on execution.
So to wrap this up, RCAT Holdings is a bet on the geopolitical trade. It's the U.S. needing non-Chinese drones right now, and RCAT having the keys to the factory.
That's the macro view. It's a bet on the world becoming a more dangerous place, unfortunately.
But I want to leave you with this thought. The company is doubling its factory size and launching sea drones while facing a lawsuit about whether they can even build what they promised. Is this the ultimate sign of management confidence, a damn the torpedoes approach? Or are they sprinting to outrun their own burn rate?
That is the multi-billion-dollar question.
And the answer likely arrives on February 13th. We'll be watching. That's the lowdown on RCAT Holdings.
Thanks for listening.
Don't forget to subscribe and hit the like button. We'll see you on the next one.